Hello, today I will cover economic mode, which is the most important concept in investment valuation. Economic mode refers to a durable competitive advantage that allows a company to generate excess returns over a long period of time. If you remember from your Economics 101 class, markets tend to be very competitive. This means that the price equilibrium in a perfectly competitive market is such that firms earn no excess profits and returns.
What do I mean by excess returns? In valuation, excess returns arise when a company's return on invested capital is above its cost of capital. You calculate the return on invested capital as a ratio of net operating profits and losses after taxes, or NOPLAT, over invested capital. As for the cost of capital, it measures the combined cost of equity and that of a company.
In my future videos, I will have more in-depth discussion on return on invested capital, as well as the cost of capital. So stay tuned for that.
To understand excess returns, imagine a simple situation. You borrowed $100 from a bank, charging you a 5% interest rate. Think of $100 as your invested capital, while 5% as your cost of capital. You are thinking of investing this money into corporate bonds. If corporate bonds earn you 8%, you will earn 3% in excess returns. Anything below 5% is unprofitable.
Many companies fail to generate excess returns due to fierce competition, but a minority succeeds by building economic moat. So what are the main sources of economic moat? They are these 5 items. So let's start tackling them one by one. So let's start with intangible assets, which refer to brands, licenses and patents. For example, consider NVIDIA. NVIDIA has many patents related to its graphics processing units. This makes it very difficult for NVIDIA's competitors to replicate its technology without explicit violation of NVIDIA's patents. This allows NVIDIA to charge premium prices for its GPUs used in cloud servers as well as gaming. Another example is the brand. For instance, Apple built a strong brand around its products. When I think of Apple, the things that come to my mind are quality, ease of use, reliability, and strong service. This allows Apple to charge premium prices for its products. Switching costs are the cost that a company's users will have to incur as a result of switching to a competitor's products. Switching costs include things like financial cost, as well as time to learn a new product. Also, a user will have to go through a so-called transition phase, which can be disruptive to its business too. For instance, there are negligible switching costs for grocery shopping. For this reason, grocery stores cannot charge premium prices. For this reason, grocery stores will have to come up and build their economic moat through other means, such as cost efficiencies.
Consider another extreme example of the ASML company. ASML produces huge lithography machines for semiconductor manufacturing. Intel, Taiwan Semiconductor Manufacturing Corporation, Samsung, and others buy these machines to produce CPUs, GPUs, and other chips. For super minuscule chips at 2 or 3 nanometers, there are no alternatives to ASML. Thus, the switching costs are infinite.
The network effect is another source of economic moat. It is very common among social media companies and payment service providers. As more and more users join a network, its value grows. At some point, the network gets so large that everybody wants to be part of it. As this happens, the marginal cost of gaining additional user for a company that owns network becomes negligible, and this allows a company to charge premium prices for its products used in the network. For example, take Facebook. As its network grew to a gargantuan size, advertisers flocked to its network. A reach to a diverse group of consumers makes Facebook a top spot to advertise products out there on the internet. Conversely, there are dozens of social networks that you never heard of. All of them fail due to the inability to gain size. For instance, Google Plus comes to mind when I think of this. Another source of economic moat is the cost advantage. An example of cost advantage is the economies of scale. The economies of scale allow a company to spread its fixed cost over a large number of products. As this happens, the company's cost per unit goes down. For example, consider Costco.
Costco built a large network of warehouse stores that sell goods in large quantities. Due to this, suppliers are willing to negotiate lower prices with Costco to tap their scale of sales.
Companies can achieve cost advantages through other means, such as innovative business processes. For example, consider IKEA, which is the largest furniture company in the world. IKEA standardized its products that made them ideal for self-assembly. This allowed IKEA to drive its production and storage costs to a minimum. Another example of efficient business methods is Amazon's highly automated delivery distribution centers. This allows Amazon to reduce its reliance on costly labor, it allows it to minimize delivery errors and speed up delivery times. Finally, there is an efficient scale that can also build economic moat. You often see this among regulated or capital-intensive companies. For instance, a small city doesn't need 2 airports or it doesn't need 2 utilities. Having too many utilities and airports makes it very inefficient and unprofitable to operate these companies. For this reason, certain companies, such as utilities or airports, they serve as monopolies in certain geographic areas. In return, they are subject to regulation. So, those were the 5 sources of economic moat. So, the next time you analyze a company, look out for those 5 sources. I would say that this is more of a qualitative analysis rather than a quantitative one. In particular, pay attention to the following. First, watch how competitive advantage plays into the length of a product life cycle. The longer the product life cycle, the more durable the competitive advantage. For example, Amazon AWS products have a high degree of switching costs. It takes time to learn a new platform. Moreover, the transition to a different cloud service provider can be lengthy as well as disruptive to a business. For this reason, once users park their business with Amazon AWS, they tend to stay with them and not switch. This makes the length of a product life cycle of AWS quite long, and this allows Amazon to earn excess profits for a longer period of time. On the other hand, fat products that earn excess profits short term are like one-trick ponies. Once the consumers get tired of them, they will move on and those excess profits and returns evaporate. Here's a prime example. Instant Pots produced by Instant Brands. Instant Pot was a hit shortly before the pandemic and during it. The problem is that consumers do not need 2 or 3 Instant Pots. Once they stocked up on one, that's it. Moreover, many copycats emerged that were similar to Instant Pots. And as a result of this, the sales of Instant Pots tanked. In fact, they were so bad that the company had to declare a bankruptcy in 2023. Second, see if a competitive advantage can persist into the future. For example, consider automakers who were early adopters of automation. Automation allowed them to lower the cost and gave them certain cost advantage. But over the time, many automakers, in fact almost all of them, adopted automation, and so automation is no longer a cost advantage. Moreover, because everyone was doing it and enjoying those cost advantages, to gain market share, certain car manufacturers began lowering prices. Finally, watch out for the ability of a company to renew its products. If the company dozes off, the competition is just around the corner. Everyone knows about Blockbuster Video. Blockbuster Video was relying too heavily on its physical stores to distribute movies, but Netflix came around and started shipping DVDs to its consumers. As a result of this, a slow-moving Blockbuster failed to adapt and went bankrupt. Moreover, Netflix reinvented itself several times. First, it was through internet streaming of movies and shows, and then later, production of its own content. When it comes to assessing economic moat, there's one metric that can do the trick, and that is the return on invested capital that I mentioned above. Companies with strong economic moat tend to generate excess returns that persist into the future.
Let's take the example of Amazon. Amazon pursued insane growth rates at the expense of profitability for a long time. If we look at profit margins and returns 10 years back, they were negligible. At the same time, Amazon clocked top-line growth rate of 30% at times. But after building strong competitive advantages, Amazon realized its return potential. We see that its return on invested capital increased substantially over time. Also observe how stable return on invested capital is. If return on invested capital fluctuates or shows declining trend, this could be a red flag worth looking into. The question becomes whether this negative trend is a temporary setback or a permanent failure.
This will be it for this video. I hope you learned something new today and it will help you to make a better investment decision in the future. If you did, please give this video a like and subscribe to my channel. I will have more content about investing, personal finance and valuation. Thank you for watching.